Okay, hi everyone. This is going to be the third lecture in chapter 18. So we're picking it up here with stock redemptions, right? So we said at a very high level when we started the chapter, right, that among other ways you can classify things as a dividend or a redemption, right? What's going on in a redemption, right? So a redemption is whenever a corporation buys back the stock from the shareholder for cash or property, right? So the title of this will be a redemption, and what goes on here is, hey, we give you cash or property, and you give us some of or all of your stock, right? In theory, right, what's going on here is essentially it's an exchange for the stock, right? So the shareholder is given the stock and they're getting cash on it, right? And then it says, depending on the type of shareholder, right, you can have an individual shareholder or it could be a business, right? A corporation can own a corporation like C2 owns C1. There's going to be different incentives for classifying a distribution as a dividend or a redemption. Specifically, right, in a redemption, assuming we receive something called exchange treatment, sale or exchange treatment, right, there's going to be a test here, the IRS tells us, right, we're going to be able to, as the shareholder, take the amount realized minus the adjusted basis, right, because it's like we give our stock for something. However, if it's a dividend, whatever they give you, right, you're going to have to pay tax on the entire amount. So kind of in this framework, a couple things, right? Individuals, they want to receive exchange treatment, right? When we have the factual setup of a redemption, they want to call it an exchange. On the flip side, if you're a corporation, right, you have a preference to call and want to have it be treated as a dividend, right? Because you're going to get a dividend receives deduction for it. So the IRS comes in and kind of says, look, we have tests that's going to tell us what treatment to apply to it. In other words, if you have a situation where you have a corporation that's pushing out some type of money for a certain amount of stock, right? We will have a test for you that tells you what type of treatment you get, right? So here we have that sort of redemption in title, right? It's the corporation pushes out something to a shareholder for their stock. The IRS says, look, there's two different treatments for this, right? One, potentially you could call it a dividend, right? If we push out $500, right? You would then, assuming there was E&P, right? The shareholder there is going to have $500 of dividend income. If instead, right, when we have these tests for you, you receive sale and exchange treatment, yes, you got $500, but you get to back out your stock basis, right? Because we're going to treat it like you exchanged your stock, right? Here's my stock for that. Accordingly, right, because it's a disposition event, amount realized minus adjusted basis, right, you're going to have a $200 gain, right? So if you're this guy, right, would you rather report $500 of income or $200, right? You can see the preference here for individuals is going to be, kind of going down the right side here, receiving sale or exchange treatment. So again, just kind of a pause here. The setup is we have in title a redemption, giving something for the stock, some or all of the stock. How how we tax this and the implications of that, we have a test, right? So we're going to have three tests, three independent tests, right? They're mutually exclusive. If you pass one of the three, right, you're going to go to the right and receive exchange treatment, right? So if you pass it, you're going to the right. If you fail all three of those tests, it's going to be treated as a dividend, right? So that's what this guy is saying right here. First off, the IRS doesn't want shareholders abusing the tax code and misappropriately calling a dividend a redemption, right? Accordingly, they reserve the right whenever you have, the setup to always send you to the right? And reclassify a distribution. So they want to know here, how do we know when we receive sale or exchange treatment versus dividend treatment, right? So how do we know if we go to the right or the left? Well, we have 3 tests, right? 1, 2, and 3. If you pass any of these tests, you go to the right, you receive sale exchange treatment, amount realized minus adjusted basis. If you fail all 3, you go to the left. So let's look at tests 1, 2, and 3 here, right? So we said if you pass it, right, 1, 2, or 3, any of those, you're going to go to the right, and it's considered an exchange treatment, amount realized minus adjusted basis. Let's look at test 1 here. Right, so this says a redemption receives exchange treatment. You go to the right if it's substantially disproportionate with respect to the shareholder. And basically what's going on here is we're going to have, right, we said the corporation give some property for some stock, right? And we're going to look at essentially this guy, right, the shareholder. We're going to say, what did he own before and what did he own after, right? And essentially it's going to be, the number of shares. You can start with that, but the more important thing is going to be their percentage of ownership, right? The number of shares can help us tell our percentage of ownership, okay? Now in this framework, right, we have essentially 2 tests, right? 2 and 3 here are going to be the same, right? They're both saying the same thing. So let me just cross out 3 for it. So requirement 1 says, immediately after the exchange, the shareholder owns less than 50% of the combined voting power of all classes of stock, right? So when we look at after, right, you better own less than 50% of the corporation, okay? Likewise, the shareholder's ownership of the voting stock after the redemption is less than 80% of the shareholder's ownership before the redemption. So sort of over here, right, we said you got to own less than 50%. And essentially what we do is we take your original, right, I'm just going to put your before percentage, right, whatever you owned over here before, and you multiply that times 80%, right? Your new or after ownership percentage, it better be less than that amount, right? If it's not, sorry, you don't pass the test. Let's give this some simple numbers, and then we'll look at how the book breaks it out, right? So we have kind of before and after. So suppose a shareholder owns 60 of 100 shares prior to the redemption, right? So they own 60 of 100 shares, right? That's 60%, right? So we have shares and percentage of ownership. After the redemption, right? So we have the corporation, they give some money, they buy back some stock. Okay, after this happens, right, the shareholder, we said, has to own less than 80% of their original value, right? So what we do over here is we say, okay, you owned 60%, right? So we're going to take your original, kind of your OG there, and we're going to multiply that times 80%, right? So that's going to be 48%. Let me write that a little bit cleaner over here. Likewise, right, we need to make sure that afterwards you own less than 50% of the total corporation. And you kind of establish that insofar that if you pass this, you pass that, right? So this is telling us what we need, right? They're not giving us exact numbers for what happened, but they're saying, look, if you own 60%, 60 shares beforehand, and then this happens right here, if you want to go to the right, that is to say receive exchange treatment, then afterwards you better own 1, less than 50% of the corporation, and 2, less than 48% of the corporation, right? That passes the respective 50% and 80% tests, okay? Let's look at 1816 here. Okay, we have a corporation. They redeem 5 shares of stock from a shareholder for $25,000, right? Corporation, they give some money. They get 5 shares. Guy has a tax basis in those 5 shares, right, of $10,000, right? It's $2,000 per share. They want to know what is the tax treatment to the shareholder. Okay, and then they give us some facts here, right? They have before, right, he owns 25 out of the total 125 shares, right? That's going to be 20%, right? So shares, 20%. After, right, what's going on here, right? Well, he owned 25 originally. They bought back 5. So that means afterwards, right, he's going to own 20 shares out of the 125, right? That's going to translate to 16.67%. Okay. Now, this is kind of afterwards, and then we have to compare this with the 2 tests, right? So one is this less than 50% of the corporation? Yes, right? 16 is less than 50%. 2 says, right, we got to take our original ownership percentage, right, 20% from over here, multiply it times 80%, right, and that comes out to 16%. Is 16.67 less than 16? No, we fail that test, right? We failed the 80% requirement too. Accordingly, right, even though we had a redemption in title, we're going to have to go to the left and treat this as a dividend, okay? So a couple things to be aware of here, right? The 50 and 80%, if they own multiple classes of stock, you're going to look at their total ownership of stock, okay? Here's a more important rule, right? Whenever you have test 1, right, you're going to have this be subject essentially to something called the constructive ownership rules or the family attribution rules. What does this mean? Right, so we said that you have a before percentage and an after percentage, right? We basically look at your shares that help tell us the percentage, your shares that help tell us the percentage. Here's the deal with this. When we look at the number of shares you own, right, that's going to be what you directly own, right? Maybe here's you directly own 5 shares plus what you indirectly own through related parties, right? So, hey, your sister over here, right, we'll give her some long hair, she owns 3 shares, right? So here, right, you're going to constructively own, right, of the law, fiction here, 8 shares, right? And then we would put that over the total to get the percentage. Why do they do this, right? Well, it's a related party. They want to make sure that people aren't kind of gaming the systems here. Anytime there's related parties in play, essentially it gives rise to potential for manipulating the tax code. And when we talk about related parties, right, it can be family members or it can be businesses that this guy owns part of, right? So it could be, basically a percentage of a partnership, right? So like any percentage we're going to have to kind of do some math with, or it could be a corporation that they own greater than 50% then, right? So there's a little bit difference there. We'll come to that. Right, so let's start with the idea of family attribution, right? Direct plus indirect, where it's maybe your sister, right? Or another family member. Let's look at 18.7 here. Okay, so shareholder 3 is the father of shareholder 2, right? So we got shareholder 3, right? He's the dad of shareholder 2. Looks like during the year, right, shareholder 3 receives 25 shares of a corporation for $50,000, right? So the starting point, right, is he's going to own 25 shares. And that's going to represent a 20% ownership percentage, right? So that's kind of the beginning amount or what we start with. And it says during the year, right, the corporation redeems or buys back 6 shares from this guy for $30,000. In those 6 shares, right, that he bought back, right, he's going to have a $12,000 basis, right? $2,000 per share times 6 shares is $12,000. What is the tax treatment, right? So we kind of have to do, an analysis here, right? And this is for shareholder 3, right? So we're looking at this guy right here, shareholder 3. Okay, so we're looking at the first test. We got to do before and after, right? Here's the thing, right? We got to get the number of shares, right? Well, it is going to be what he directly owns himself plus what his kid owns, right? So it's going to be 25 what he directly owns over here plus the kid owns 75 shares, that's in the fact. So he's going to own 100 shares, right? Accordingly, if there are, right, so he's going to own 100 out of the 125 total shares. His percentage then, when you put that into a percentage, right, is going to be 80%, right? Afterwards, right, after they buy back, right, they tell us they buy back 6 shares, right, he's going to own 94 out of the 125, right? When you put a percentage on that, it's going to be 79%, right? We take this amount, right? We say, one, is it less than 50%? No, right? We fail the first test. And because we fail the first test, we don't even have to go to that second test. I mean, you could do 80% he originally owns times, if we go back there, right, it's the 80% of 80%, right? Figure out what that number is there, but we don't even need to get there, right? We fail the 50% test. Accordingly, we go to the left, right? We're going to treat this as a dividend. In other words, this shareholder right here, whenever the corporation pushes out to him $30,000 for 6 shares, that's going to be treated as a dividend. Then it says, okay, if it is treated as a dividend, right, you go to the left, the tax basis of the stock redeemed, right, whatever they bought back, those 6 shares, is going to be added to the tax basis of any shares they still have, right? So we need to kind of, because we ignore the fact, right, we went to the left, we're going to sort of, for tax purposes, ignore the fact that you sold it, we're going to treat it as a dividend, then we kind of have to restore your basis to where it originally was, right? So let's look at 1818, and it builds off that example we just looked at. Right, so we said with the father, right, shareholder, I think it was 3, right, he owned 25, 6 they bought back, right, so he has 19 left. The question becomes, what is his basis in these 19 shares, given the fact that he failed the test and we went to the left and we're going to treat it as a dividend? Right? Well, because we treat it as a dividend, we're going to ignore the fact, for tax purposes, that he received exchange treatment. In other words, we're going to pretend like he kept his original stock. Accordingly, right, his basis in the 19 shares he has left is going to be basically the 38,000 in those 19 shares plus the 12,000 in the 6 shares that he had redeemed that we ignored, right? In other words, we're going to put him back into his position, right? Those 19 shares, his basis will be 50,000, essentially where he was before this, because, hey, we're ignoring the fact that, he had it redeemed, okay? The next thing to be aware of here is, right, we said that related parties also include businesses that the shareholder owns, right? So the shareholder can own, right, a partnership, right? And that's based on pretty much any percentage. But if they own a corporation, it has to, for them to be considered a related party, they have to own more than 50% for that to count. So let's look at 1819 here. All right, let's just say shareholder 3 is not the father, right? It's like Maury Povich, we're not the father. However, shareholder 3 owns 25 shares of a corporation, right? So here is corporation, we're going to put C1, right? And we have the shareholder right here who owns 25 shares. Okay? And it looks like outside of this arrangement, right, the shareholder also owns 40% of a partnership that owns 25 shares of the corporation, right? So there's a partnership here, right, and they own 25 shares, right? So they own 25 and he owns 25. However, right, we said this partnership is also owned by the shareholder 40%, right? So you can see this is a related party, right? This guy owns the corporation, that partnership owns the corporation, but that guy owns part of the partnership that owns the corporation. So they are related to each other because of, hey, he owns some of this. So how do we deal with this, right? Well, we said it's going to be your direct ownership, right? If I came up to you and I said, what does this guy right here constructively own in C1? Well, it's going to be the 25% he directly owns plus, right, 40% times the 25 shares that the partnership owns, right, 10, right? So 35 is what this guy owns, right? If I came up to you and I said, here's the setup, please tell me his constructive ownership in Corporation 1 for purposes of this test, he's going to own 35 shares. 25 he directly owns plus the 10 he indirectly owns through the partnership. All right, down here it changes the facts. All right, it says same as example 1, right? C1, and we have the shareholder. Except in this case, right, it's not a partnership, it's going to be Corporation 2. And off to the side, right, oh, I'm flying down here, right, when we look at C2, it's owned by, that shareholder, except, right, it's less than 50%. Maybe it's 30% or something. Right? In this case, because it's less than 50%, it is not a related party, right? So when I come up to you and I said, what is this guy's shares, right? It's going to be the 25 he directly owns, 0 he indirectly owns, because for corporations, it's greater than 50% whenever you put them in the indirect. For partnerships, it's not, we don't have that 50% test. It's just the pro rata amount, right? Here, 40% was good, right? There we go. If we change the facts, right, if it was 60%, right, of C2 that he owned, then it would be essentially, in that case, right, you would count the indirect ownership, right? So it would be, the 60% in that case times the 25 shares, right? That's 15, right? So he owns 25 directly plus 15 through the corporation. We count it this time because it's greater than 50%, and how we count it is proportionally. That is to say, the ownership we have, 60%, times the 25 shares that Corporation 2 owns. All right, that was test 1 of 3, right? We said there's 1, 2, or 3. If you pass any of them, you're going to go to the right and receive exchange treatment. If you fail it, you go to the left. We looked at test 1. It has the 50% test. It has the 80% test. And we said in there we're comparing before and after, and we have to be aware of related parties for purposes of constructive ownership. Now we have test 2, right? It says a redemption will be treated as an exchange. We go to the right if it is in complete redemption of all of the stock owned by the shareholder. In other words, if they just say, hey, look, we're going to buy back all of your stock. Well, if you think about it, right, if they buy back all of this guy's stock, you're automatically going to meet the 50 and 80% test from test 1, right? Why even have this rule? Well, really, it comes down to that constructive ownership rules, right? So it says if, for example, a corporation is owned completely by a family, the attribution rules would make it very hard to meet the 50 and 80% tests, right? As a result, this kind of secondary test comes in and says, look, we're going to essentially, to provide you some relief here, waive the family attribution rules, right? The related party rules for test 2 if certain requirements are met. So let's look at 1821 here. Actually, let's go back to 1820 just because I do want to show you the flip side of it. Right, so we looked here at the setup where it's what the shareholder directly owns plus indirectly owns, right, of that corporation. Right, if we said it's a partnership, it's going to basically be pro rata, the percentage they own times the number of shares the partnership owns. And if it's a corporation, right, we only count it if it's greater than 50%. Now, right, if we just want to, look at the flip side, say it's, the shareholder and the partnership, right? If I came up to you and I said, what does the partnership own, right, in the corporation? Those constructive ownership rules cut both ways. Right, and it says here, right, so shareholder 3 owns 25 shares. They also own 40% of a corporation that owns 25 shares. How much or how many shares of stock does the partnership treated as owning? Right, well, essentially here, right, it's a little bit interesting because when we go to the flip side, right, we look at this guy, under the entity attribution rules, you're going to treat the partnership as if it owns all of whatever its partners own. So here, right, it's going to be all of what the partners own. If it was a corporation, right, you're going to treat it, right, so if it was a corporation, it will have that 50% test too. In other words, if we have the shareholder owns more than 50%, then we're going to have our direct ownership percentage in it plus what that shareholder owns. So it's a little bit different when you look at the flip side on it. Let's go to 1821 here, right? Because we're now moving into that second test, right? So shareholder 3 is the father of shareholder 2 before he owns 25, after he owns 75. During the year, they redeem all of shareholders 3 shares for 125,000 for the year, right? They have CEP. After the event, shareholder 3 is still treated as owning 75 shares through his son, right? So we have, a related party here. Thus, like on paper, if we were to just run this number, we're going to fail test 1, right? The substantially disproportionate test, right? How can we change this outcome, right? If we fail test 1, and really it's these related party rules that are doing it, one of the things we can do is we can look to test 2, right? We could say, is this considered a complete termination, right? Well, yeah, you're giving up all of your shares. Accordingly, we will waive those family attribution rules. And by virtue of waiving the family attribution rules, and we're treating it as a complete termination, you will go to the right and receive exchange treatment, right? In other words, so what's the simple way of remembering test 2? If they buy back all of the stock of the shareholder, you go to the right? You receive exchange treatment. And then the third one here, right, you go to the right. Is this not essentially equivalent to a dividend test? And really, this is based on the facts and circumstances, right? You really kind of have to dig in and say, is this not really a dividend? Is it truly an exchange, right? So you look at the facts and circumstances. But one of the things here is there is a 50% test, right? So that will kick in. Let's look at 1822 and 1823. right? So it looks like we have a shareholder here. During the year, they redeem 5 shares for $25,000. They have a $10,000 tax basis. Let's say it's not essentially a dividend test, right? So a couple things here, right? Essentially what's going on is there is a redemption, right? The titling there. We look at the facts and circumstances and we say, look, it's not a dividend, right? The facts and circumstances tell us it's not a dividend. And after that happens, right, the guy owns less than 50%, right, of the corporation. Accordingly, we're going to go to the right. We will give it exchange treatment, amount realized minus adjusted basis. There we go, right? So this one, like, it's hard to test in the sense it'd be like a dead giveaway. The only thing I could really test is the 50% aspect of it, right? So here's another kind of configuration of it, right? So in the first one, there were not related parties, right? We went to the right. On the second one, right, we have a father in play, so there are related parties. Let's see here, right? It says, what is the tax treatment in this case? Well, we fail test 1, we fail test 2. And also, the facts and circumstances here are going to tell us, right, and this will be given to you, that it's not essentially dividend. The reason for this, right, is we're going to fail the 50% test. So in other words, what's going on here is afterwards, right, for purposes of test 3, right, there's kind of 2 components, right? There's going to be a facts and circumstances component that says, hey, it's not really fair to go to the left. However, the second part of it says, look, we're going to look at what you own afterwards, what you directly own plus indirectly own, and that better be less than 50%, right? Here, it was more than that, right? I don't know what the percentage is they're saying. You'd have to look at the facts. Maybe it's 60%, right? You fail test 3, you go to the left, you receive dividend treatment, right? Right there. Finally here, right, we talked a little bit about, whenever we have non-liquidating distributions, right, we said that you recognize the gain from it, but not the loss, right? That'll increase your taxable income. That's kind of everything we said here, right? A couple things now to build off that is if we have a redemption, right, and it's treated as a dividend, we go to the left. What then happens, right? Because we've been talking a lot about the effects for the shareholder. What are the effects for the corporation, right? Well, they're going to reduce E&P by basically the cash that's distributed and either the fair market value or the E&P adjusted basis of the property distributed. If we go to the right, so that was this guy right here, right? We go to the left and we got dividend treatment, right? What the corporation does, I don't want to make that green. Right, we're looking at the effects of the corporation. You go left, dividend, you're going to reduce E&P. If you go to the right, we have the redemption and it's treated as an exchange, then the corporation is going to reduce the E&P at the date of distribution by the percentage of stock redeemed. So if there was 60%, they're going to reduce E&P by 60%. Not to exceed the fair market value of the property distributed. So it's going to be the lower of those two. Let's look at 1824. Then we can button this up. Right, so they're giving us a fact set here. Right, it looks like they redeemed 25 shares for $125,000. There was a tax basis. We went to the right, there was a redemption. We went to the right. There was exchange treatment. That's great. That's what the shareholder gets, exchange treatment. What's the deal for the corporation, What's the effects here, Well, essentially, they're going to have to reduce their E&P. And because we went to the right, it's going to be the lower of basically the percentage here times the E&P, right? So there was 20% that they bought back. So 20% times the E&P, 100,000, or the fair market value of the property distributed, 125, right? So basically you map this out, pick the smaller, that's what the corporation reduces E&P by. If you were to map it out, right, and the fair market value was smaller, that's what they reduce E&P by. So what's going on here, right? We run the numbers. We have a redemption. We go to the right? There is exchange treatment. We know the effects for the shareholder, amount realized minus adjusted basis. What are the effects for the corporation? Well, because we went to the right, we have to reduce our E&P, right? And what we reduce our E&P by is the lesser of basically the percentage times E&P, right? 20% up there, the percentage that we bought back in the redemption, or the fair market value of the property paid to the shareholder. Okay, so with that, I'm going to end the lecture here.